Okay, let's talk about the taxation of Section 1231 Realty. So, just as a review, we have three types of assets: ordinary income assets, Section 1231 assets, and capital assets. So, look at this description of the capital 1231 assets: depreciable or real property held for productive use in a trade or business. So, we're talking about assets used in a trade or business. Now, 1231 can include both realty and personalty. And why does the type of asset matter? Well, it's a tax treatment. So just as a, you know, review here, you see that the tax treatment is different for all three types of these assets. So what we're going to talk about is the taxation of capital 1231 assets, and specifically we're going to be discussing realty, not personalty in this discussion. There's a small difference. So it must be used in a trade or business or for the production of income to qualify as Section 1231 property, and we're talking realty, which think land and building, as opposed to personalty, which is movable stuff. So okay, so here's land, which of course we don't even depreciate land, remember, but buildings, uh, developed land, undeveloped land, apartment buildings, and rental housing. Um, when we say it's held in a trade or business or for the production of income, we're talking about real estate here held for the production of income that is depreciable, and for various reasons that are not important. If you own a rental home, it's not considered a business, its own rental, and that's why we don't say real estate just only held for used in a trade or business. The production of income refers to holding a house for rental purposes. So, we're not talking here about stocks and bonds held for the production of income. We're talking really about rental real estate. Okay, so first let's talk about Section 1231 realty property sold for a gain. Okay, so as you can see, of course, it gets capital gain treatment. Now, part or all of the gain may require recapture, so we haven't yet discussed what that really means. So here's our first example. So Rachel had the following situation when she sold her rental home, which she had owned for several years, so we know it's long term. So she had a cost basis of 150. She had taken depreciation of 40,000 on it, so she had an adjusted basis of 110,000 at the time she decided to sell. She had a sales price of 200,000 minus the adjusted basis, so she had a gain of 90,000. So as her financial planner advised her how that gain will be taxed. Well, okay, so we've got this capital gain treatment, which we've talked about before, but part or all of the gain may require recapture. So this is something kind of new. And what that means is that the gain due to depreciation is taxed at 25%. The remainder of the gain is taxed at the capital gains rate, assuming it's long term, which of course here it is. So what is the gain due to depreciation? So here is the little calculation that you're going to do. You're going to take the total gain of 90,000 and you're going to subtract the depreciation. Now, that 40,000 is going to be an amount that will be taxed at a 25% rate, not at the capital gains rate. The remainder of the gain, the 50,000, that will be taxed at the capital gains rate. Now, the reason this is done is because when depreciation is taken, Rachel got an ordinary deduction off of her income taxes. And so when she has a gain, the portion of the gain due to depreciation will be taxed at not at ordinary income rates, but at 25% rate. And we don't even have a 25% bracket anymore, but that's the way it is. That's the way it is. Okay, so another Section 1231 realty sold for gain, example 2. Ross had the following situation when he sold his apartment building, which he had owned for several years, so again, long term. He had a cost basis of $1,050,000. He had taken $650,000 of depreciation. He had an adjusted basis of $400,000. So he sold it for $1,200,000 minus the adjusted basis, so he has a gain of $80,000. So again, how will this gain be taxed to him? Well, same deal. Part or all of the gain may require recapture. Gain due to the depreciation is taxed at 25%. The remainder is taxed at capital gains rate. So just take a second and do this simple calculation. And so, of course, we take the gain minus the depreciation. This leaves $150,000 of gain to be taxed at the capital gains rate. The $650,000 of that gain is going to be taxed at 25%, so it's kind of stiff. Now, why does it matter whether the gain or how much of the gain is taxed at 25% or gets capital gain treatment, they ask? Well, because, of course, obviously the capital gains rates are lower than that 25%. Also, recall when we discussed the taxation of capital assets, that capital losses can only be deducted against capital gains, and there's a limit of $3,000 net loss, capital gain loss that can be deducted in any one year. And ordinary losses, like business losses, can only be deducted against ordinary income. So ordinary losses, they're not limited, generally speaking. So when they sell their property and part of that gain is ordinary and part of it is capital gain, it's going to affect how much capital losses they can deduct against it or how much ordinary losses they can deduct against the ordinary gain portion. Okay, so she had a gain of Section 1231 property, as we just saw in this example, capital gain 50, ordinary income 40. Now, other income information we know about Rachel, which, well, we're just finding out about Rachel, is that from other stock sales that we don't have details of, she had a loss of $54,000, and she also had business losses of $45,000. So wasn't a great year for Rachel. But here's how her gross income will look on her income tax return. She is going to have capital losses, long-term capital losses of $3,000. Now, where did that come from? We took her capital gain of 50. We subtracted the capital losses from the stock sales because they have to be netted capital to capital. And so you come out, of course, with a negative 4,000. However, it's limited to taking a loss of 3,000 in any one year. So that remaining 1,000 will be carried forward. The thing to notice here is that she was at least able to use up these capital losses against these capital gains. So that's good, because if she only had the 54,000 capital loss at $3,000 a year, I mean, it's going to take a long time to use it up. So this is a good thing to be able to get a tax benefit from the losses on the capital stock sales. The next thing on the gross income on the tax return, we go down and look at the ordinary losses. So she had 40,000 of ordinary income, and so she had 45,000 of business losses, and so she only has to report a loss of $5,000 on her income tax return. So she's able to sort of negate all that ordinary income from the sale of the Section 1231 property by the business losses. So when we add those two down, well, Rachel's only going to show gross income on the tax return of a negative 8,000. So, well, she's not going to pay much in tax this year. Okay, Ross, on the other hand, as we know, had capital gain of $150,000 in ordinary income as part of the gain on this sale of Section 1231 property of $650,000. Now, his other income, he had the same other income. He had long-term capital losses from stock sales of $54,000, business losses of $45,000. And so here's what he's going to show on his income tax return as gross income. We're going to net his capital gains. He's going to come up with $96,000 of long-term capital gains. He's going to have ordinary income of $605,000. So those business losses can reduce that ordinary income that he's going to show. So on his tax return, he'll show gross income of $701. So again, you net capital gains and capital losses, and ordinary income and ordinary losses together. So Ross's income will be subject to the net investment income tax. The ordinary income from this sale of Section 1231 is his net investment income. Okay, minus the $3,000 loss that he could take on his tax return. So don't forget about that net investment income. When you sell Section 1231 property, it is going to be subject to that net investment income tax. Okay, so your income tax planning principle: control the timing of gross income. So if it's possible, use your capital gains in order to use up capital losses to negate each other. Use capital losses to shelter large capital gains. For year-end planning, if you can, and sometimes it's possible, time gains to reduce and postpone taxes in the NIIT. And tax, remember, should not drive portfolio allocation, but you can use a portfolio to your best advantage. So these tax planning principles really are something we've talked about before, but it's a good review. Okay, let's talk about Section 1231 Realty property sold at a loss. Now, Section 1231 losses can be deducted against ordinary income, and those losses are generally not limited. Okay, because as you can see, if you have a loss on Section 1231 assets, they get ordinary loss treatment. So, for example, Phoebe has $3 million of wage income, good for Phoebe, and $500,000 of Section 1231 losses. So her gross income is going to be $2,500,000, the $3 million minus your $500,000, because you can deduct that ordinary loss against ordinary income. So great. If her losses of $500,000 had been treated as capital losses, she could only do $3,000 a year, because she would not be able to deduct them against ordinary income. However, again, Section 1231 assets, you get ordinary loss treatment. So this is really a benefit for business assets, because if you have capital gains, it's better to pay at capital gains rates rather than ordinary income tax rates. But if you have losses, then you're not limited by that $3,000 limit that you have on non-Section 1231 capital losses. So again, really the same tax planning principles here for losses.